Welcome to Neko Hina's tutorial. To Leo video, please like this video and subscribe to our channel.
Right now, covered call ETFs are everywhere, promising something that feels like an investing cheat code. Funds like QYLD offer yields of 11, 12, even 13%, and they pay out that cash every single month, no matter what the broader market is doing. That kind of payout naturally attracts a huge crowd. You've got beginners chasing the highest yield they can find, young accumulators hoping to supercharge their compound growth, and retirees who urgently need cash flow to cover their daily living expenses. But when you see double-digit yields, you have to ask a structural question. Are these funds actually manufacturing new wealth, or are you just getting your own initial investment handed back to you, a few dollars at a time? In the market, high yield is never free money. Someone is always paying for it. And with covered call ETFs, the person footing the bill might actually be your future self. Let's look at exactly how this plays out, using the most famous fund in this space, QYLD. In 2021, tech stocks were surging. QYLD investors were happily collecting their 12% yield checks while the underlying market ripped higher. This chart tracks QYLD's performance right after that peak. On the left, the marketing promises an 11 to 13% yield. But on the right, you see the actual share price drop from $25 down to $16 over 2 years. That is a 36% collapse in principal. Even factoring in generous monthly checks, the cash received didn't come close to covering the capital lost. Meanwhile, an investor who simply bought and held QQQ, the exact same NASDAQ stocks without the option strategy, experienced the same dip but eventually recovered and hit new all-time highs. The QYLD investor never recovered their initial capital. This proves why looking at distribution yield in isolation is dangerous. Total return, which combines the cash distributions you receive with the change in your share price, is the only number that tells you if your wealth is actually growing. To understand why that principal erosion happens, you have to look at the mechanics. These ETFs generate their massive payouts by systematically writing covered call options against their stock portfolios every single month. This diagram shows the direct trade-off of that strategy. By selling a call option, the fund agrees to cap its upside at a specific level, known as the strike price. In exchange for accepting that hard ceiling, the fund collects a cash premium, which becomes your monthly dividend. But look at what happens during a massive bull run. When the underlying stock blows past the strike price, you don't get any of those extra gains. Your return is pinned flat, while the broader market leaves you behind, and the ceiling only works in one direction. While your upside is strictly limited, your downside is completely exposed. If the underlying stocks crash, your ETF crashes right along with them. You aren't hacking the system. You are systematically trading away your long-term capital appreciation to get immediate, highly taxed cash flow today. QYLD applies the strategy to the NASDAQ 100. It targets tech stocks specifically because the NASDAQ is highly volatile. Higher volatility makes options more expensive, which allows the fund to collect fatter premiums and pay a higher yield. Look closely at the prospectus documentation. It clearly outlines the structural risk of this exact approach, noting that the premiums received may not be enough to offset the losses caused by the volatility of the underlying tech stocks over time. The math is unforgiving. When the NASDAQ drops 30%, QYLD drops with it. But when the NASDAQ eventually rebounds by 30%, QYLD's covered calls cap the recovery. The fund drops like a rock, but bounces like a wet sponge. If you want passive income without that extreme tech volatility, you have to change the underlying index. That is where a fund like XYLD comes in, applying the exact same covered call strategy to the S&P 500 instead. This matrix shows the trade-off. Because the S&P 500 is less volatile than the NASDAQ, the options generate slightly less premium, giving XYLD a lower trailing yield of around 10 to 12%. But the underlying index doesn't swing as wildly. By accepting a slightly lower payout on a broader, calmer index, you protect yourself from the massive principal bleeding that plagues tech-focused funds during market corrections. You can go one step further to protect your capital by moving away from automated, passive call writing entirely. A fund like JEPI takes a different approach to generating income from the S&P 500. Instead of blindly selling options right at the current stock price every month, JEPI is actively managed. The portfolio managers use out-of-the-money options, giving the underlying stocks some breathing room to actually go up before hitting the strike price ceiling. As we update the matrix, you can see GEPI's advantage. Human managers adjust to market conditions on the fly. In a strong bull market, they write fewer calls so the fund captures more upside. In a flat market, they write more calls to boost income. GEPI forces you to accept a lower yield, usually around 8 to 9%. But in exchange, that active flexibility preserves your net asset value significantly better than any rigid automated strategy. Finding the right fund is only half the equation. Where you hold these ETFs dictates how much money you actually keep, because covered call strategies carry a massive hidden penalty: tax drag. The cash generated from selling options isn't treated like a standard qualified corporate dividend. It's often classified as ordinary income. If you hold these funds in a standard taxable brokerage account and you're in a high tax bracket, the IRS will take a massive bite out of your returns. This brings us to the most important rule for young accumulators. If you have a multi-decade time horizon, relying on covered call ETFs is a severe misallocation of your capital. You should avoid high-yield option strategies entirely. Your focus needs to be on uninterrupted total return. Use traditional dividend growth funds like SCHD or VIG, or buy pure broad market indexes like QQQ and SPY to capture every ounce of market upside. Sacrificing your long-term compounding potential just to get a taxable 12% cash yield today will mathematically cripple your wealth over the next 30 years. These tools are engineered for a very specific demographic: retirees or near retirees who need to pay their living expenses right now and want to avoid selling their stock shares during a market downturn to do it. And to make the math work, you need to shelter that ordinary income. These high-yield vehicles belong inside tax-advantaged accounts like an IRA, where you can collect the monthly payouts without getting hammered by taxes. This flowchart shows the final strategic checklist. Avoid the QYLD volatility trap. If you want a passive S&P 500 income stream, look to XYLD. And if you want active downside protection that preserves your capital, rely on GEPI. Covered call ETFs are highly specialized tools for extracting income. They are not designed for growing wealth. Remember, a 12% yield means absolutely nothing if your principal is vanishing.